All right, one more whack at big government socialism and a lot of banking bureaucrats unelected who think they're running the country. Joining me now is David Malpass, president of the World Bank Group. Welcome back, David. So, to start with, the original sin of this whole problem is too much spending, too much borrowing, and too much Federal Reserve money printing late to the party and zero interest rates. So now, as head of the World Bank, where do we go from here?
The challenge is, how do you allocate losses? So if you've held down interest rates for a long period of time, then there's going to be a workout phase, a long period of asset repricing. So the capital was concentrated into a narrow group, and now that misallocates it. So you don't get as much global growth and investment as you needed.
An example of asset repricing for our viewers.
We're seeing it in bonds. So bond prices have gone down, and that's hurting the banks. But we have to wonder about real estate, about Bitcoin, about all of the assets. Because as the interest rates were low and bond yields were low, that means the price of stuff was pushed up by regulatory and by monetary policy. And of course, the fiscal government spending was part of that, not just in the US, but really in all the advanced economies. So it concentrates the capital in a narrow group, and it allocates it not to small businesses, but to big businesses, to governments. And so now we're in the workout phase.
Bad for growth. Bad for growth, by and large. Very bad for growth.
Small businesses need the capital, poorer countries, and where there's population growth, you have to find a way to put that in. India might grow 8% if they could get the capital from world markets.
How about, we talk about bond risk or stock risk and duration risk. How about regulatory risk? You have a bunch of erratic regulators and supervise. I mean, you know a lot about it. The supervisors didn't supervise. The bank examiners didn't do their job. And now they're trying to blame, under-regulation. Don't you think there's regulatory risk?
There is, or there's decisions made all the time by regulators. It's somewhat political, and they made a big decision to regulate the credit risk, but not so much the duration risk, the interest rate risk.
Bonds,
and so you end up with in Europe, people owning lots of bonds of weak countries, but not the companies that could have created new jobs and new growth. You end up with less growth. And I'm worried that right now we're in a phase with so much government debt that they will absorb all the world's capital. The world's a wonderful place. It creates new capital all the time. But if it's all absorbed in government deficits and in future central bank bond buying, which is what they're saying they're going to do, they're going to keep...
Which is not productive. It doesn't help productivity. It doesn't help innovation. It doesn't help incentives to work, save, and invest, really. And it's not sound money either.
Not sound money. It doesn't give you sound money. I'd rather they were really clear. We want sound money, and we want production. That the central banks and their policies, also government fiscal policies, affect whether people invest and whether they invest in small business. So just say it. If what governments want and recognize is you have to have small businesses to get jobs, then say that's what you're doing.
That would be a good thing.
That would be good.
We should go for growth. I just don't hear enough go for growth. Steve Forbes had it right. He calls it modern socialism through the regulatory state. Unelected regulators doing very weird things. Akil is yelling at both of us to get out. David Malpass, World Bank, old friend. Sound advice. Thank you, sir.